Hello students and welcome to video 1 in chapter 1.5 Growth and Evolution, and this is the 5th chapter in topic 1 Introduction to Business Management. In this chapter we're going to be looking at 5 learning objectives. What I will say is I've divided this chapter into 4 different videos, which kind of just shows how important this chapter is. Historically it's been very popular for IB exam questions, so I will be going through this one in quite a lot of detail. In video 1, we're going to look through learning objectives 2, 3, and 4. Video 2, we'll look at economies and diseconomies of scale. And then later on, we're going to do 2 videos on these 5 external growth methods. So firstly, this chapter is called Growth and Evolution. So it's all about how businesses can grow. So we kind of need to define what is growth. And what we're going to take here is growth is when one of the metrics used to determine the size of a business increases. And so we've looked at these in the previous chapter, but these are basically, we can measure the size of a company through sales revenue, we can look at profit, we can look at market share, we can look at market capitalization. Market capitalization is kind of the value of the business on the stock market. So we can look at the price per share multiplied by the number of shares. It's often abbreviated to market cap. And in finance, we'll go into a bit more detail about that, what that means. And then also the number of employees. So if we take a couple of different metrics here, on the left, we've got market capitalization. So you can see that as at the time of this recording this video, Apple's well ahead in terms of market capitalization with Microsoft. Saudi Aramco is the Saudi Arabia oil company, Alphabet, Google, and then Amazon. But if we look at revenue, then we see that actually none of those companies is up at number 1, and Walmart is their number 1, with Saudi Aramco 2, Amazon 3, etc., etc. So before we look at what it means for a business to grow, we need to be clear, but what does it mean by growth? And different companies will use different metrics when they talk about wanting to grow. So to give you an example of how a business might use different metrics in terms of growth, this is the annual sales revenue of Amazon from 2004 to 2022. And what you see here is really quite a nice, beautiful graph. Okay, it goes up nicely and then becomes exponential up here. And so for Amazon, this is a really nice diagram to look at because their sales revenue has gone up quite consistently. However, if we look at their profit, so net income is, we could say that's profit. We can see that until about 2016, Amazon didn't really make that much profit. I know they're still making some profit here, a few millions here, or a few hundred million, which is obviously not nothing. But compared to the sales revenue we just looked at, where the sales revenue is clearly going up every year, their profit really didn't go up until like 2016. And what we can see here is clearly a strategy by Amazon. Before 2016, they were trying to increase market share. They were just trying to increase revenue, get more people using Amazon, get more people using the platform so that they can have more customers. And then you can clearly see here around 2017, profit became more of a focus for them. So here you can it demonstrates how businesses can kind of approach growth in different ways. Next up, why might a business want to grow? And again, this might sound a bit obvious, but it's not necessarily so. And so one reason would be higher sales revenue, and this potentially would mean higher profit. Now, not always like we saw with Amazon, but in general, a business that's making higher sales is likely to make more profit. My face is getting all in the way here today. Higher market share, which means hopefully more power in the market, and also better brand recognition by customers. And as a result, supermarkets, shops are likely to put this business's products in better places. And you then kind of get this cycle. So the higher the market share that a business has, then they're going to get a better brand image because of the higher market share. And therefore, because of the higher brand image, then they're more recognized by customers, better placement in shops, which should then lead back to higher market share. So as a business gets bigger, you kind of get this cycle where it becomes bigger and bigger, in theory. Not always, but in theory. We're also going to get economies of scale, which we're going to look at. There's my face again, can you believe it? Which we're going to look at in the next video. So basically, economies of scale is as you produce more, then we become better at production, more efficient at production, so we can produce things at a lower cost. We're also going to have more power over suppliers because we're buying more at once. Then we're going to have more power in negotiations with suppliers. So we should be able to buy our raw materials for a cheaper cost. It's also going to be a sense of achievement for owners. If an owner's taken a business from a sole trader through partnership, they've been incorporated, to see the business grow for the owner can be a real sense of achievement. And that might be one reason why the owner wants the business to grow. And finally, we can invest in more research and development. So research and development is investing in basically ways in which we can make the business, the product better. And so the bigger the business is, the more of that we can do, which hopefully should give the business an advantage going forward. There are other reasons, but these are the main ones. So we've talked about why a business may want to grow in size. Well, what about why might a business want to stay small? Because not all businesses grow big. Some businesses don't grow big because they can't, because there's too much competition in the market. But some businesses choose to stay smaller because that's what their objectives are. So what might some of these reasons be? Well, firstly, it's going to be easier for the owner to manage. If it's a sole trader or partnership or even a small privately held company, then the smaller the business is, the easier it is to manage. And sometimes an owner might not want to grow big because it then becomes more difficult to manage. Quicker decision making. So the smaller the business is, the easier it is to make decisions. Basically, there's less stakeholders involved. There are going to be less employees. And therefore, it's going to be easier to make decisions. You should, in theory, be able to give more personal service to customers. So again, the smaller the business, the less customers you're going to have in theory. So hopefully you should be able to give each of those customers, more personal service. And next, growing may require additional investment, which may mean giving up some control of ownership. So generally, if a business wants to grow quickly, they're going to have to take some sort of additional source of finance, which in many situations may be share capital. So getting an investment from outside the business, gain more money, which we then use to propel the business forward. This, in theory, is going to lead to a loss of control. And if it's like a small family business, then they're not necessarily going to want to give up control of the business. So this is where the business has to decide, if we want to grow quickly, we probably have to give up some control, or we can stay the size we are and just grow slowly, or just keep it as it is. And so that's a decision that different businesses will make in different ways. So what is the ideal size of a business? Well, it kind of depends on so many factors, but you could say the three main ones are here. So one is, what are the objectives of the business? Again, if an owner wants to make quick decisions, make it easier to manage, keep it in the family, then they're likely to keep it small because those are the objectives of the business. The size of the market, if the market's small, then it's obviously going to be a lot more difficult to grow. And also the level of control wanted. So if this is a family business where the owner wants to keep control of the business and not have other people investing and telling them what to do, then they're likely to not accept that investment and keep the business small. Okay, finally, the difference between internal and external growth. We're going to be talking about this later, but just briefly, what's the difference between these two? So internal growth is when the business uses its own resources. And the key thing is they don't involve other businesses. And so this might be financed through things such as loan capital, share capital, retained profits, etc. And it's generally going to look like, how do we grow the size of the business? Well, we can open new shops, we can open a larger factory, we can expand overseas to get more customers, we can move into different markets, etc. The key thing here is we're not using other businesses. We're not involving other businesses in the growth of the business. Now, that might seem a bit confusing. So if we look at external growth is when we expand using other organizations. And what do these look like? Well, these are the 5: mergers and acquisitions, takeover, joint venture, strategic alliance, and franchises. And we're going to be looking at those 5 in videos 3 and 4. Okay, that's it for now. I'll see you in the next video.